Hey everyone, Nick here, doing homework on Sunday night on the 7th of January. So I'm starting with the SPY, but first let me tell you what's in this video. At the end, I'm going to tell you what it means for trading the major indices, and there are some really specific things at the end, so you might want to stick around. First of all, where we're at. After a record run of 9 straight green weeks, we finally had one red week. The downside of having such a good run is it feels very painful on the way down. Then we will talk about the fact that the Nasdaq and the small caps were hit the hardest last week. And the Dow is really the coin flip this week, and I have specifics at the end, so stick around for that. All right, so let's start with the S&P. First of all, the emotional triggers this week. I think we have a few Fed heads still talking, not sure what they have to say. And also we have some inflation reports scattered. I think there's a CPI, maybe a PPI. The S&P, looking on the one-day chart, we don't have anything to say except, oh boy, we haven't even started falling. We can fall another 3.5%, like the Nasdaq did this past week, and just be okay. Also, we can say that it's an inch away from breaking out to new highs. Right at 460, we had prior fails, many of them, and the upside potential of those can be, believe it or not, as big as this. Whoops, that's a little too big. As big as that. So let's say we give them half. That's a lot of points from here. So from the close, that is 50, 60 points. Bulls in charge on a weekly basis. All right, let's get into some nitty gritty. Also still with the S&P now on a 1-hour chart. This is the comment. I would use strength to fix struggling short-term bullish trades. In terms of measurements, if they don't rally and hold 1.2 to 1.3% this week, the S&P, it's at risk of slipping a little bit lower to that box down there. So 1.5 to even maybe 2.5%. Now, the QQQ has fallen a lot more than the S&P, which means I forgot to mention that it completely priced out the Fed pop. This was it, December 13th. Unlike all the other indices, they have not yet. So the rallies will face immediate resistance and then resistance through 2%. So even if it rallies, like I said, on the S&P, if it doesn't rally 1.2, this one needs to rally like 2.5 to 3% just to get out of the muck. And if they make a higher high, of course, they can go another 2 to 3 or 4 or 5% up. So keep an eye on the mega caps to see if they can do it going into earnings. Otherwise, this one may slip a little bit lower. I would say it has risk to another 2% lower, and it's going to be harder for it to fall than, say, the S&P or the Dow, because it has fallen already quite a bit more. So the conversation with the small caps, the IWM or the RUT, is similar to the Nasdaq. Even if they rally maybe up to 4% and fill this arrow, they could still fade it and make a lower low. So they need to rally a lot more than 4%, and they can do it. This bunch can move fast in both directions, unfortunately. And it too did not fill the December 13th spike from Powell. So here too, if I get strength and I have short-term longs that were struggling, I would use those longs to get out or to short and bet lower. I'm not convinced that this bunch is ready to take off, but I'm definitely not shorting harshly. So you saw my shorts are credit call spreads, bear call spreads. I'm leaving plenty of room in time and distance from current price. Okay, so this is the most fun this week. This is the Dow. Believe it or not, this is going to be exciting right off the bat on Monday. I hear that Boeing has had an unfortunate incident in midair. A piece of a plane flew out and somebody grounded it. It is a big component of the Dow, so it may drag the Dow down. The other one is UNH. UNH has its own struggles, and it's the largest in the Dow. So now, here's the variable that comes in at the end of the week. Bank earnings start. And although they don't react to earnings well historically, they are big stocks in the Dow. JP and Goldman, they are big. What do I mean? They have a high ticket. Their stock price is high. So when they move, they have a big impact on the Dow, more than Apple. This is the IWM, which I focused on last week. I'm going to focus on the IWM again. Why? They've spent a year consolidating. So they're just peeking their head above, and now they're going back to test the breakout candle, which is actually 2 candles. So what happens at 190 for the IWM? Is this going to happen? So are they going to repeat this behavior here? And if so, then that kind of puts them back into the consolidation zone, which wouldn't be good. I don't think the S&P or the QQQ or the DIA can continue if these guys can't get out of these consolidation zone. Trust me, they have a date with a huge rally if they can just clear it. How they can do that, I'll tell you exactly how. They can have a 20%, maybe even a 30% rally from here. How? They just need to make a higher high than 2 weeks ago. So I'm going to put an alert at 205.5. Let's go to 206. And if they go there, oh boy, they can just take off like bandits. And they would have made the turn. All right, so to summarize, I'm still, as far as timeframes are concerned, I want a pullback to continue. Maybe have a flattish red week this week. I don't need a disaster. I just need a little bit more consolidation to have the bulls breathe a little bit so we would have a better quality continuation of the upside in this year. Otherwise, we leave ourselves open to sharp corrections. I will take it line by line. Even though I think we need to pull back a little bit more, I'm not going to short if I see the price action go bullish again. Okay? And we've seen it happen before.